Good evening, everyone, and a very warm welcome to everyone for today's masterclass on financial modeling for CleanTech. It is definitely our pleasure to introduce Professor K.N. Badhani, who is the Professor of Finance and Accounting at IIM Kashipur, with over 3 decades of academic experience and a PhD in accounting. With that, I would like to hand over the forum to Professor Badhani. Over to you, sir.
Okay, thank you. Thank you very much. So, good afternoon, everybody. Uh, the task what I was given has three basic elements. So, first, we have to learn some Excel skills. Number two, we have to discuss some financial concept. And third is the green tech context. So, I will try to balance these three with giving more weight on how financial modeling is done. That means the Excel skill part will be emphasized, and we will learn certain financial concept, how those are dealt in Excel. And of course, we will keep the context of our discussion focused on uh, green technology. So, I will share my actually Excel sheet because most of the things we are going to discuss on Excel only. So I will share my Excel sheet here. I hope you are able to see the Excel sheet here.
Yes, sir.
Okay. Yeah, thank you. So let us start from the basic concepts, how we do financial calculations in Excel. So whether we talk about the valuation or the project feasibilities, the basic concept here is we are getting some cash over the period of time. So, for example, you invest in some project, suppose a solar power project. What you are expecting? You are expecting that at the beginning, we can call it time zero, current time, you are investing something, invest. And then over a period of time, maybe from first year, second year to suppose its life is up to 20 years, you get some cash, sorry, you get some cash or some cash flow in return. Sorry for this. Yeah. So you are getting some cash flow in return over the period. So what is the question we are asking basically? We are asking the question, is this cash flow is sufficient enough for me to take this investment? Am I getting my investment back and some reasonable return over this period or not? So how we answer this question? We actually convert this cash which we are getting today or after 1 year or after 5 year or after 20 year equivalent to the cash today. So we discount or find out the equivalence of this entire cash today, and then we compare with what is the value of the cash we are getting over the period and what is the value we are investing today and what is higher. Which figure is higher? Suppose I invest 50 lakh rupees and whatever I get over the period, that is 55 lakh rupee. It means this investment is worthwhile. We can invest here because we are getting more than what we had invested. But suppose we are getting something 40 lakh over the period of 20 years, then this investment is not worthwhile. So this is the basic concept we follow in all these financial calculations. So now what are the main factors which decides the feasibility of a project or the valuation of the company also? These are only two. Number one, what is our future cash flow? And that future cash flow depends on how much revenue we are going to earn from those projects, and what will be the cost, and what will be our margins. So, suppose in our example, we are generating energy. So, the basic question is, over this period of time of 20 years, how much energy we will generate? At what price we will be able to sell that energy? And how much revenue we will earn over this period? What will be the cost of generating that energy? And how much we will be able to save for ourselves? What will be the margin? Those margins will basically decide how much cash we will be able to generate over the period. The second thing, we have to discount this cash which we are getting over the period of time today. And for that, we use this K here. The K is called the discounting rate. Now, this discounting rate is the function of basically risk. So, how we define this discounting rate? This discounting rate is the minimum return that we are expecting from this project. We are saying, if I get this much of return, suppose I get 12% return from this project, then only I will invest in this project. So that is my hurdle rate or cutoff rate. This return is minimum what I am looking for. Below this, I am not going for this project. So that is called the discounting rate. Now, how much return we look for from a project, that depends on the risk of the project. If the project is not risky at all, the required return will be less. If the risk is higher, we ask for more return to compensate for our risk. For example, if some project is giving only, say, 6% return, should we go for this? The answer is no, because we can earn 6% return on our money simply by putting this money in FD. So this 6% is my risk-free rate of return. So if I am investing money in some business, I will say, okay, I can invest my money in the business only if I get something more than 6%. So the 6% is the base. It's the risk-free rate of return. Plus, how much more I will ask for, that depends on how much risky the business is. If the business is little bit risky, I may say, okay, I am satisfied at 8%. So 2% more I am asking to cover up my risk. But if the business is highly risky, I may say, no, I will not invest in this business unless I get 20%. So here I am asking for how much? 14% more over the risk-free rate of return. So whatever money we ask over the risk-free rate of return, that is called the risk premium. Now, this risk premium, as we have already seen, is determined by the risk. So risk is the main determinant of this. So, in nutshell, we can say the feasibility or viability of any project, viability of any project depends on two things. Number one, how much money the project is capable to generate over the period of time. That depends on revenue, cost, and margins. Number two, how much is the risk involved in that project? So, this is the basic idea of any calculation we are going to have. Okay, the second thing what I will do, I will show you some basic financial calculations. So before we go for a case study for today, let us discuss some few very important calculations which are required. Okay, so suppose you have some money today. Suppose you have 1 lakh rupees, right? And you invest this money, suppose in FDs only. What happened? Why it's not going away? So you have suppose 1 lakh rupees and you want to invest this money in FDs where the rate of interest are 6%. So this is the money that you have today. We call it P, and you invest in FDs. FD's rate of FD is 7%, and then you are investing it, say, for time period 5 years. Okay, how much money you will get? We call it the future value, F. This is equal to, as you know, it's equal to the money multiplied by 1 plus R, rate of return, to the power time. Okay, so this calculation can be done like this. I show you the calculation. So P into 1 plus R to the power T, right? So I can share with you these formula, although these are very basic formula. We learn them in our schools. So this is the first formula. And so what we are doing, we are calculating the future value from the present value. F is equal to P into 1 plus R to the power T. But in many financial calculations, we do just opposite. What is opposite? Opposite is like this. Suppose I need 1 lakh rupee after 5 years. After 5 years. And banks are giving me the return at the rate of 7%. Now the question is, how much money I need to invest today to get 1 lakh rupee after 5 years? So you saw this formula. We have to now flip. We have to put P this side, F this side. So this will become like this. Present value is equal to future value divided by 1 plus R to the power T. So this is called the discounting. The first process is compounding and this process is discounting. So we are discounting 1 lakh rupee from future to present. So we can do like this. So F into 1 plus R to the power T. F upon 1 plus R to the power T. So if I have 71,000 rupees, 71,299 rupees, I invest it for 5 years. After 5 years, I will get 1 lakh rupees. So in finding present value here, we use this concept. We have some money that we are expecting to get in the future. We have to convert them equivalent to present, right? So this is called, discounting process. Now, the third process that I want to discuss with you is the future value of an annuity. What is future value of an annuity? Suppose I put every year from first year to fifth year, every year I put same 1 lakh rupees. Okay, every year I am putting the money in the bank. And I am putting this money in the bank at the end of the year. So this is called an annuity. So my annuity is 1 lakh. So how much I will get? If the rate of interest is 7%, then this money, this 1 lakh, will remain invested for 4 years. So 1 plus 7% multiplied by, oh sorry, not 77, 7% multiplied by 4 year. Why 4 year? Because we are investing at the end of first year. So 5 minus 1, this is getting invested for 4 year. So in 4 year, this will become 1,31,000. This second amount will remain invested for 3 years. This third amount will remain invested for 2 years. Fourth amount will remain invested for 1 year. And the last one is the just invested money. So if somebody is accumulating 1 lakh rupee every year for 5 years, how much money he or she will get at the end of this period? So this is 5,75,000. Okay, so you got this example, I hope. So this is the calculation of the future value of an annuity. And putting little bit of mathematics, I will not go into that. We can solve that this can be calculated using this formula. Future value of an annuity is equal to annuity into 1 plus r to the power n minus 1 upon r. So let me take this formula here so that you can see it. Ah, I hope you can see it. So if I use this formula, so the future value will be 1 lakh, which I am investing every year, multiplied by 1 plus R, 1 plus R, 1 plus R 7%, 7% to the power n are 5 years, 5, minus 1, this whole divided by R, 7%. Okay. Yeah, so we are getting the same figure here as well. So this is how the present value of annuity is calculated. But we need not to use this formula even. There is an inbuilt formula in Access, which is uh, future value, FV. So if you just write FB, it will ask you to write something. For example, what is the rate? Rate is 7%. NPER, number of payment periods, 5. PMT, per payment period, amount per payment period, 1 lakh. PV, present value, is 0. Type. Now, type is written 0 if you are investing at the end of the year, 1 if you are investing at the beginning of the year, 0. And just close this. Okay, I have put one extra bracket, I think. So if I use this formula, then also I get the same figure. Okay, so this is how we can do this calculation. And this calculation is quite handy when the same cash flow is occurring repetitively over a period of time. Okay, so this is annuity. Annuity means some person is okay. You might have heard about the RDs, recurring deposits, where you are putting the same money every month and you want to know after 5 years how much money I will get back. So this calculation is done, okay, like this. The next one, uh, just opposite of this, which is more important in the financial modeling. Suppose you want sorry you are getting some money in the future. Suppose there is a project which is giving you the same amount every year for say 8 years. 8 years. So you are getting 1 lakh rupee from a project every year. This is the money you are getting, 1 lakh every year for 8 years. And suppose the rate of discounting is again what we assumed is 7%. So the question is to get 8 lakh rupee every year for 8 years, how much money I need to deposit today? So I need to deposit today. Suppose I deposit X money today. My objective is the bank should give me 1 lakh rupee for 8 years. And the bank's interest rate is 7 year. The question here is, what is the value of X? How much money I need to deposit today? So that will be equal to, now this money the bank is giving me today. this will include the interest of 1 year. So the money required to get 1 lakh rupee after 1 year. So its present value is, I discounted by the 7% to the power 1 year, because it's we are getting it back after 1 year. This is the money I need to put today. So if I put 93,000 in my bank account in FD for 1 year, and the interest rate is 7%, I get 1 lakh. So same thing we can repeat for all these figures. So this, to get this scheme of 1 lakh rupee for 8 years, I need to put total money today in the bank. This is equal to 5 lakh 97,000. So a 5 lakh 90,000 investment today can give you 1 lakh rupee for 8 years. This is called the future present value of an annuity, this concept. And mathematically, I am not going into the math, but it can be calculated using this formula. So if I use the formula, it's equal to A, 1 lakh rupee, multiplied by 1 minus 1 plus R, which is 7%, to the power, sorry, to the power minus of n are 8 years here, okay, divided by R is 7%. Yeah. So this formula is also giving us the same value, but for you, more useful is the formula of present value. So just write PV in your Excel sheet, and then rate. Rate is 7%. NPR, number of payment periods, 8. PMT, payment per period, 1 lakh. Future value 0, type 0. So using this Excel inbuilt formula also, you will get the same amount. So these are some calculations which you may need to make your financial, models. Okay, now coming to what Syam is saying, let us start with a model building. So financial model means we have to project future cash flows. We have to project how much we are going to get in the future, and what is the value of that money that we are going to get in the future, and to decide, is the money that we are spending today worthwhile to spend to get the future cash flow. So to give a context here, I will discuss about a small solar power project. So suppose I'm going to install a small power project, and the capacity of this project is 50 megawatt. Capacity factor is 20%. That means we will be generating in average 20% power from this power plant. Life of the project is 20 years. And capex required is 4.5 crore rupee per megawatt. So how we finance this? To finance this, we are using debt initially, 70% debt and 30% equity. The debt will involve 9% interest rate. Tenure of the debt is 12%. That means we will be repaying the debt, and we will be able to clear the debt over 12 years. Cost of equity is 15%. Now, this concept I will come back. What is the meaning of this? But we are assuming that the investor, the equity holder, is expecting minimum 15% return. So he's saying, if returns are not 15%, I will rather not go for this project. So here, this 15% is our hurdle rate. Corporate tax rate is 25%. So whatever earning there will be, that will be taxed at 25%. O&M operating and costs are 2% of the capex. So operating and maintenance cost are 2% of the capex, and O&M escalation is 5%. That means O&M cost will increase at the 5% rate every year, and the tariff is 4.2 rupees per kilowatt. Okay, so this is a simple, very simple, may not be very realistic. You can add more complexities later on. But we will do some calculations based on this, very easy kind of setup. We are saying that today we will make an investment of how much? So this is 50 megawatt plant, and the capex requirement we have estimated is 4.5 crore every megawatt. So 4.5 crore into 50 megawatt, this is coming 22.5 crore or 22,500 lakhs of rupees. So this is first important thing, that today I have to spend 22 crore, 22 lakh 5,000 rupees. Okay, now how much electricity it will generate? So it's a 55 megawatt plant, and uh, and we can see that the capacity factor is 20%. So 50 into 20%, this is the average energy it will generate every hour. And how many hours are there? 8,760 hours in a year. So there are 365 days in the year, and each day has 24 hours. So if you calculate it, the total hours are 8,760. So those 8,760 multiplied by 50 megawatt multiplied by 20% of the capacity factor, that will give us total megawatt, total kilowatt electricity it will generate every year. So it's coming 8 crore 76 kilowatt energy every year. Now, how much will the money I will get from selling this energy? So, in the example, we have assumed the energy will be sold at the rate of 4.2 rupee per kilowatt. So, multiply this by 4.2. So, I multiply this by 4.2, and all the figures I am converting into lakhs. So, I divide it by lakh. So, every year I will be getting a revenue of 3 lakhs 6,790, no, sorry, 3,679 lakhs. So this is my annual revenue. But there will be some cost, maintenance cost and running cost also. And project expert tell us that this cost is 2% of your original investment. So in the first year, 2% of 22,500 lakh. So it will be 450 lakh rupees in the first year. But our assumption here is this OM cost will accelerate, will increase at the rate of 5% every year. Okay. So with these basic assumptions, now let us go to financial modeling. And Syamji, this is what we call the financial modeling. That means making a Excel sheet to forecast what is going to happen over the period of time. Now this is the first table, and I will explain you how I have created this table. These are the years from first year to 20th year, because the life of this project is 20 years. How much revenue we are going to get? We have assumed that this is the revenue. we have done this calculation. So every year, this project will generate for us 3,679 lakhs rupees. And we are assuming that this is not going to increase. This will remain constant. I will discuss with you how we deal with inflation in projects. So there are two approaches. Either we take care of the inflation at this point and increase the price every year, or the other approach is we do the real analysis. That means we assume that the price will remain constant, but we increase the rate of return K. Okay, so right now we are going with that nominal approach. So we are assuming that revenue will remain the same over the period. Now, O&M cost, operations and maintenance cost, as the project life will go, it will become older, we need more maintenance. So here the assumption is first year's maintenance cost is 450, but after that the maintenance cost is increasing at the rate of 5%. So maintenance cost we are increasing by 5%. Look here, first is 450, next is 1 plus 5% of the 450. So if we take this figure and then after that, so I will show you how I have calculated. So after that, if I just, drag it, so those who have not used much Excel, they can see here. So if you just drag it, we will get all the calculations. So what is it is doing? It is taking 5%, adding 5% every year over what we spent last year. So this is O&M. So from revenue, when operations costs are deducted, in finance we call it EBITDA. EBITDA means earning before interest, tax, and depreciation amortizations. So this part is EBITDA. So EBITDA is very easy to calculate. From revenue, subtract your costs. This is EBITDA. Now we are subtracting depreciation. So we are investing 22,500 crores, no, sorry, lakhs of rupees, and the life is 20 years. So using a straight line method, 22,500 are spread over the life of 20 years. So here is the depreciation. 1,125. So we are charging this depreciation every year. So when from EBITDA depreciation is subtracted, it's called EBIT, earning before interest and tax. So here is the EBIT. Here we calculate EBIT every year. So this is the EBIT from the project. Now, we have assumed that the government is going to take 25% tax. So this EBIT is our profit and the government will take 25% tax. So now look here, what we do in these calculations, we do not subtract interest. Okay, interest is not touched till now. I will show you when we calculate cash flow to equity, then we will subtract interest. But when we are calculating cash flow to enterprise, cash flow to firm, then interest is not deducted. So we are taking the profit which is before interest, earning before interest and tax. Then tax is deducted. So after deducting the tax, this is what I am getting. It's known as NOPAT. NOPAT means net operating profit after tax. So this is the NOPAT which this business is going to generate over the period of time. Okay, I will take a pause here because I have introduced many important financial terms up to now. Okay. Any question up to here? Anything you want to add or you want to ask? So NOPAT, you have asked, NOPAT is net operating profit after tax. So this is the profit. So what is the sequence? We have revenue. From revenue, we subtract the cost of the operating the business. That is known as EBITDA, EBITDA. Then we deduct depreciation. We get EBIT, EBIT. Now from EBIT, when we deduct tax, it's called NOPAT. Okay, NOPAT we had calculated. Once the NOPAT is there, we can calculate what is known as free cash flow to firm. Free cash flow to firms. FCFF. Free cash flow to firm. So how we calculate the free cash flow to firm? Uh, so in the first in the zero year means right now, today, we are investing 22,500 lakhs rupees in this project. This is our investment. And investment has a negative sign because it's cash outflow. Now, what we are getting from this project in return? We are getting our NOPAT plus this depreciation. Why depreciation is added back here? So we are adding back depreciation to NOPAT to find out the cash flow. Why depreciation is adding back? Because depreciation is not an expense. It is not a cash flow. Depreciation is an accounting treatment. So what happens when we charge the depreciation? Nothing goes from my pocket. So if I pay salary, I pay in cash. When I pay interest, I pay in cash. But when I charge depreciation, nothing goes from my pocket. It is an expenditure you have done at the beginning. Now you are spreading that expenditure over the life of the project. So depreciation is a non-cash item. So in calculating this NOPAT, depreciation was simply calculated to find out how much tax the company need to pay. Once the tax amount is decided, now we add back this depreciation, and the cash that we are getting from the project is NOPAT plus depreciation. So this is the cash flow we are getting. So this is now the project cash flow from firm's point of view. So this project, we are spending 22,500 right now, and this is the money we are expecting that we will get over the period of time. Okay, now from here, we can do many calculations. What calculations we can do? The first calculation we can do, we can ask what is the rate of return involved here. It's known as internal rate of return, or IRR. How much return this project is giving to me? So if somebody invests 22,500 rupee right now and then get all this money over next 20 years, how much return he or she is getting? So it can be calculated in Excel using the formula IRR. So IRR of all these values, select all these values. These are the cash flows, free cash flows. So you calculate free cash flows and then select them, use IRR function in Excel, and it also asks you to give a some figure for the guess or to start the calculation. So I give 10%, around 10% may be the answer, and then ask it to give the correct answer. So it is giving me 9.52%. So its IRR is 9.52%. Is it good to invest at 9.52% or not? This we will discuss shortly. But you may have a cutoff rate in your mind. Suppose your cutoff rate is you are saying, okay, I will not invest in any project which is not giving me 10%. So if this is my cutoff rate, I will not go for this project because this is giving me less than 10%. It's giving me only 9.52%. Right? So this IRR is then compared with the cutoff rate or the hurdle rate, which generally the business or the investor choose for herself or himself, what is the minimum accepted rate of return I should go for. So I hope,
3000 लिखते मेरे कहने के 3
please, yeah. So I think there are some questions here. So the depreciation is used effectively to lower the tax. Yeah, it's right. It's correct. Okay, yeah, it's a good question. Not always the investment is made in one go. In some cases, the investment may involve in transit, right? So, but that will not change our approach. In that case, what will happen? During different years, the investment figure will be negative and the cash flow figure will be positive. For example, suppose I go in the basic page again. So if in some business we are spending 1000 rupee first year, and then again 500 rupee next year, and then we are getting 400 rupee for next, say, 10 years. So our investment was 1500 spread over 2 years, and then 4000 is the money that we are getting over 10 years. So IRR can be calculated easily here as well. IRR is equal to this cash flow, and then some rate we will have to give to start with 10%, suppose. So we will get the figure. We are getting 20% here. So that does not make a big difference, although mathematically it becomes challenging. Those who know the mathematics well, they will appreciate that here what we are calculating, in fact, we are calculating a root of a polynomial equation, and when there are two negatives here, there may be some imaginary roots also involved. So mathematically it's a challenge, but Excel will take care of that and it will give you a neat figure in return. So don't worry about that part. Any other question? Yeah, these are the questions I am going to ask you. Don't worry about that. Her ROE and other things are calculated. Yeah. Anything? Anybody interested to make any comment or want to ask any question directly? No. Okay. So let me go to one of the question that you are asking. What is the accounting rate of return, or what is return on capital employed? So return in capital employed is a accounting concept. And how we answer this question? So ROCE, return on capital employed, it's equal to the profit. A profit means EBIT. So for example, our first year CBIT is this much. Divided by, if we divide it by the investment that we have made, it's here. So 22,500 rupee of investment is giving me 2,104 rupee of profit. So return on capital employed is 9%. So it will differ from year to year. So every year you will have a different figure. Or alternatively, what you can do, you can take the average over the years. So average profit over the period of 20 years is average of EBIT. So we are taking EBIT, not the cash flow in this case, because this is an accounting concept. So the average profit over the year is 1,810, and the investment that we are making is 22,500. generally what happens, because this 22,500 will exhaust after 20 years. So we take the average investment. That means we divide it by the two, because in accounting, when you will be preparing the balance sheet, the value of your assets will also go down. So the accounting rate of return is average profit divided by average investment, which is equal to around 16% over the period. So the average ROC is 16% in this case. So ROCE is basically an accounting concept. Return on capital employed is an accounting concept, and here we use the accounting, figures. So basically we use EBIT and the investments. So on every balance sheet we can calculate EBIT separately, or for the life of the project we can take average. So for the life of the project we can take average EBIT and average investment. Now average investment means, in this case our assumption is after 20 years this solar plant will have no value at all. So we are taking average of 22 lakh 22,000 lakhs and zero. So we are taking half of that. So this is ROC. Okay. So this is how IRR is calculated. We can move to now, because you had asked a very important question. So let me address that. So what is cash flow to equity holders? That is very important concept. Now, so far we have looked at the cash flow of this project from the point of view of the firm as a whole. Now, what is the cash flow from the point of view of a shareholder or the owner of the business? How we can do it? Look here. First, let us see this project is being financed. We are told that 70% of the project, that means 22,500 multiplied by 70%, this will be financed by debt. So we are using debt to finance this project using 15,750 rupees. And the rest of the money, that means the 30% of the project will be financed by the equity. So equity is 6,750. So this is the financing mix of the project. इतना पैसा हम लोन ले रहे हैं, this is debt, and here is the equity. This is the money which the investor is putting. Now debt is to be recharged, refunded within 12 years. So debt tenure is 12 years. So you have to take debt after 12 years, within 12 years you have to pay it back, and the interest rate is 9%. So suppose you are returning the same money every year. The question is how much money you will return every year. So this is the question. This question can be answered using the concept of annuity. What is the annuity to pay a debt of 15,750 when the interest rate is 9% and you have to refund it in 12 years? So every year, how much debt servicing we will have to do? That means how much we will return principal plus interest to make this possible. So we use here the formula PMT. Okay, this formula is coming from the same formula that I introduced, PV, present value, future value formula. So here is PMT. PMT means per month or per period, how much payment you have to do. So first write rate, then NPR, 12 years, then PV, present value. That means that we are taking today. Future value, what will be the balance debt after 12 years, which is zero, and type is zero. So every year we have to refund 2,199. You can see it here. So at the beginning we take a loan of 15,750. Then for 1 year 9% interest will be added. After adding the interest, this is the total money you have to pay. then you pay this money at the end. So this is the balance. Now this balance will go in the second year. Again, the interest will be paid. Then this is the money you have to pay. Then again, you are paying the same installment. Then this is the money which will outstanding at the end. So you can see if we repeat this calculation for 12 years, in 12 year, our money will become zero. The debt will become zero at the end. So every year we have to pay this much. And this is the interest which is added to the loan. So now if we take that also in account, okay, so here is the investment and this is EBIT. From EBIT, if we deduct interest, we get earning before tax. Then we recalculate the tax. We will get earning after tax. We add back the depreciation again here and subtract the debt refund that we are doing, eh, the principal refund. We will get free cash flow to equity. So here is the free cash flow to equity. So from equity holder's point of view, he is investing this much and this is what he is getting back. So you can again ask the question, what is the IRR here? So IRR for the equity holder is IRR for this cash flow. So it's coming 13%. So the equity holder will be earning around 12.78% in this project. This is how we can calculate it. And one important concept remained here is net present value. So what is the concept of net present value or NAV and how NAV can be calculated? So let us take this cash flow to firm here. So we had calculated the cash flow to firm here, cash flow to firm, and we want to find out what is the NAV of this project. So how do we do it? So first of all, we should have a cutoff rate, a hurdle rate or a cutoff rate. So let us assume that this cutoff rate or the hurdle rate K is 9%. Okay, so what exactly we are saying? We are saying that we will not accept any project unless the project gives us 9% rate of return. So if this is my hurdle rate, then what I will do, I will calculate the present value of all the cash flows here, the free cash flow we are getting. So take the free cash flow and discount it using this 9% hurdle rate to present. So 1 plus R to the power T. The same formula I introduced at the beginning of the class. So we convert all these cash flows to their present value equivalent. So this is the present value of the cash flow that we will get. So sum of the present value of the cash flow that we are going to generate from this project is, you see, it's 23,000. Then from here, we subtract the money that we are is investing in this project. So we are investing 22,000, right? So we are getting 23,000 after investing 22,500. So what is the net present value we are generating from this project? So here is our net present value. So in this example, our net present value is 813 lakhs of rupees. Now, the project is accepted only when this NAB is positive. NAV will be positive when your hurdle rate is below your IRR. Suppose your hurdle rate is higher. Suppose your hurdle rate is 10%. That means you are saying, I will not accept any project unless the return is 10%. So in that case, okay, so I have not used, I have manually written 9%. So let me change it to 10%, which is coming from here. So 10%. I make it fixed here. So at 10% rate, yeah, this has become negative because this time my hurdle rate is higher, IRR was lower. So net present value will become negative. So if net present value is negative, it means the return which this project is generating is in fact lower than what I am expecting from the project. So I will not go for the project giving negative NPV. Yeah, now this is very important question, how the cutoff rate is decided. Now this is very actually academically also challenging and a very important question, how the hurdle rates are decided. Now look here, hurdle rates are basically dependent on what is known as weighted average cost of capital. What is weighted average cost of capital? Now weighted average cost of capital, look here, at the beginning what we are doing, at the beginning we are putting 30% equity and 70% debt. Now equity in the question itself, in the problem itself, we have assumed the equity has a cost of 15%. But what is the meaning of this? It in the market, this kind of the business need at least 15% return to the shareholder. Okay, sometime in academic finance we use models like CAPM, and we calculate the beta to find out how much risk is involved in the business and what should be the cost of equity. But I tell you, being a teacher, this exercise is more academic rather than the practical. In the practical setting, we ask the question, we compare the business, which business is more, bear more uncertainty or more risk. Higher is the uncertainty, we will ask for higher cutoffs. For example, as I told you, 7% is the FD return. So no, never in India, and the hurdle rate will be below 7% unless there is some subsidy or given by the government. 7% is the minimum because it's risk free. Plus, what we will do, we will add something for risk. Now, suppose I am doing a very low risk business, like I am selling wheat, or I am selling, I am a kirana store. So risk is very less. So I can say, okay, if I invest in FD, I get 7%, but if I get 9%, Kirana store is okay. But rather than Kirana store, if I am going for, suppose, a jewelry shop, okay, 9% is not enough there, because there is lot of fluctuation in the price of jewelry. So I am bearing more risk. I will say, okay, I will not go for jewelry business unless the return is 12%. So this is the basic idea of adjusting your cutoff according to risk. Okay, so in the question, we are given that 15% is the cost of equity and cost of debt is 9%. 9% means we are getting this loan at 9%. But look here, there is a benefit of using debt. When we pay interest, we save tax. Okay, if this project had totally financed by equity, you might have paid this tax, which is written here. But since it is paid using, okay, sorry, where is it written? Here. This is the tax you will pay if this is 100% equity financed, but you are paying less tax here. This is the tax when it's, financed partially by debt. So you are saving some tax. It's called tax shield. So this is the amount you are saving because you have used debt. So to adjust for that tax shield, what we do, we calculate the cost of debt after tax by using this formula. Interest rate or before tax cost of debt multiplied by 1 minus tax rate. This gives us after tax cost of debt. Now 70% is financed by debt, 30% is financed by equity. If you take the weighted average of these two, that means 15 multiplied by 30 plus 6.75 multiplied by 70, so we get a cutoff for this particular project 9.2. although we can discuss more complex issues involved, but for time being we can assume that 9.2 is my cutoff. And as I calculated earlier, the IRR for this project is coming 9.52. So from that angle, this project is acceptable. But if you see from equity holders point of view, equity holders minimum cutoff is 15%, but equity IRR is only 12.78% here. It means equity holders are not getting what they are expecting from this project. Although overall project is good, but from equity holders point of view, it seems that the project in our example is not giving them adequate return. Any other question? Okay, so I will stop here for the paucity of time. We cannot discuss many other questions that you had asked. I'm sorry for that, but I hope uh, we discussed a few important things today evening. Anything you want to add at the end? Any question? आप ओरली कुछ पूछना चाहते हैं पूछ सकते हैं. अगले 2-3 मिनट में हम वाइंड अप करेंगे.
Yes, yes.
Anybody? I think one question is here. In the case of the power project, what is capex opex assumption for the smart metering effect depreciation? Yeah, opex capex is okay. Question I had got earlier also, so I should answer this question. So you are saying okay, everything depends on our capex opex assumption, right? But this is not assumption. This is actually estimation, because all the decisions are taken for the future, so no figure is final, all the figures are estimates. So if I am going thinking to start a power project, I will have to estimate how much money will go from my pocket as capex at the beginning, and how much money will go from my pocket every year when I will be running this project, how much electricity I will able to generate, at what price I will able to sell it. All these are estimates. Yes, the project viability depends on these estimates, and there is risk also. My estimates may go wrong. If my estimates go wrong, then the NPV or IRR I had calculated at the beginning may not be correct. So that risk is always involved. So what actually we do in project analysis, first we make some assumptions or some estimates, then we change those estimates. What will happen if my capex go up by 10%? What will happen if my electricity generation is not 20% of the capacity, it's only 15%? Will still my project be feasible or not? So that part is known as sensitivity analysis. So we change our assumptions, our estimates again and again to find out if some of my expectations go wrong, will the project still be viable or not? So that part is called sensitivity analysis. In Excel, it's very easy to do. If every calculation is linked, na, you have done the calculation correctly and every cell is linked, then you just change that cell that you want to where you want to change your assumption, just change it, you will get a new calculation and new figure. So doing this is known as sensitivity analysis, which is very important part of any project evaluation process. How do you calculate the project payback period? Okay. Uh, okay. So undiscounted cash flow, right? So how do we do it? Basically, payback period means in how many years we are getting our cash back. So if I again share with you and answer this question. So, for example, what is the payback period here? That means in how many years we are getting back our 22,500 lakhs. So in first year we are getting 2,703. Then next year we are getting this 2,703 plus again 2,686. So cumulatively we are getting 5,389. So we calculate cumulative cash flow over the period. So this is cumulative cash flow over the period. Now the question is, when we have recovered our original investment. So you can see we are able to recover our original investment by this year because we had invested 22,500. Here we have this money recovered. So it's a 9 year. So the payback period of this project is 9 year. This is how we calculate the payback period. And payback period is not an indicator of the profitability of this project. It is an indicator of the riskness. Lower is the payback period. That means as early as we, get our money back, better is the project in the sense I have less uncertainty. यदि मैं 2 ही 3 ही साल में मेरा पैसा वापस आ जाए तो उसके बाद चलो प्रोजेक्ट चलेगा जितना चलेगा ठीक है बट एटलीस्ट आई गॉट माई मनी बैक. So this is a indicator which is used to take care of the risk part of the project. I hope there is no any further questions, so we will stop it here. Thank you very much for attending this webinar.
Uh, Thank you, Professor Badhani, for such a clear and insightful session. And thank you all our participants for being such an engaged and interactive audience. We hope today's masterclass helped you better understand how robust financial modeling supports, informed investment decisions in specifically clean tech field. Whether it is from evaluating projects viability to structuring the, capital for long-term sustainable growth. For those who wish to build a deeper expertise in net zero strategy, sustainability leadership, clean technology, and transition economic, I am Kashipur, in collaboration with EV Acad, is offering a PG executive program in net zero strategy and sustainability leadership. We are successfully running the first cohort of this program, and the admissions for the next cohort is now open. If you would like to learn more, please scan the QR code which is available on the screen, or you can check out the chat section for the direct link. Thank you once again for joining us today, and we definitely look forward to welcoming you all for the upcoming various events which we are going to, launch for you guys. Thank you so much.